Hello, and welcome to today's Levantine Market Chats. In our discussion today, we plan to take a deep dive into the current investment environment. Why do we start our webinar series right here with this topic? Because we are living through a paradigm shift. Since the great financial crisis, we have seen almost 15 years of unprecedented liquidity as central banks poured money into markets and an environment with nearly zero inflation. Last year, inflation finally started to peep its head but was treated as transitory, even by the Fed. Once markets realized it was here to stay, the Federal Reserve executed the most aggressive rate hike policy in history, and we saw the most severe correction in markets since 1969, as both equities and fixed income receded simultaneously. So, what does this all mean? Today we are joined by Laurent Joly, Levantine Chief Investment Officer, to answer some of these questions and discuss how we see the outlook for markets going forward.
We'll just start the presentation by just a couple of slides recapping really what happened in the past 18 months, very briefly. Obviously, we're all aware that inflation was a big issue after probably 15 years of no inflation and even negative inflation all over the world. 2022 was a big change, and the reason for it were probably several. The trigger was probably coming out of COVID and all the bottleneck on the supply chain side to start with that's been created, and that started to force prices to go up for suppliers. And then in the course of the year, the inflation was passed on then to the demand side, which is the customers. The reaction to inflation that we've seen was an unprecedented tightening of the financial condition by the central banks.
So as you start, Laurent, can you just explain, because I think it's really important, is the trajectory of what we saw last year compared to previous years, because you can see a significant rate hike compared to 2015 and 18, for example.
The central banks increase interest rates to often either fight inflation or cool an economy that is overheating. So it's increasing interest rate is not necessarily bad for an economy, and that's what we've seen in the hike cycle in 2015, 2018, where the economy was doing well and the Fed increased interest rate in response to the economy being a bit too strong. This time around was completely different. It was very much a reactive response to inflation going through the roof. And that's why the trajectory of last year's hiking cycle was very different and much more violent that we've ever experienced. And that translated in very difficult market condition in pretty much every asset class in 2022. And if we look at just performance, we've put this table as an example of a performance of a portfolio, typical balanced portfolio, 60% equity, 40% fixed income, which is typical a medium risk portfolio. We see that last year was one of a handful of years where both asset class went down at the same time. And the amplitude of last year was even more than we've ever seen. So even in 2018, which was a tricky year, especially towards the end, fixed income market was flat and the equity market was slightly down, while last year, both asset class went down quite dramatically.
And something you might recall at the beginning, I said about since 1969. So if you have a look at this, you'll see, yes, the 2008 crisis, we saw equities tumble, but you saw the 10-year up 20%. It's literally since 1969 where it's the first time since then you see both asset classes simultaneously pull back like this.
The same information slightly in a different way, just to show how 2022 was an outlier compared to the other years in the past 20 years plus. The Fed had a really big role in markets all over the world. I know this presentation is probably, you might say it's a bit centric towards the US and the Fed, but effectively they're the bellwether and they decide for the rest of the economic world and the market what's going to happen. The Fed has two main mandates. One is price control, which is controlling inflation, price stability it is. And the second one is related to employment, to keep an economy as close to employment as possible. We've seen very interesting evolution in these two parts of the economy in the past 18 months. So inflation, as mentioned, going through the roof very quickly. But the good news is that we've seen the inflection point, and we feel that now inflation has turned and is going to come down. That's in the US. Effectively, we can say that most of the increase in inflation has been done, and now the pace of inflation is slowing down. That doesn't mean that prices are going to go down, but prices are going to increase less fast than we've seen in the past. And a similar picture happens in the Eurozone. So the ECB this time has also been quite active and increasing interest rate quite aggressively. And we've seen the headline CPI also turning a corner, and headline CPI is the overall inflation. But what's an important one is the core CPI, which is the most sticky part of the inflation basket. The headline would include something like, for example, the energy sector, which has turned dramatically over the past few months, from very high levels. So this has turned, which made the headline CPI turning. But what we're looking at is the core CPI, which is the most sticky part, which is shelter, which is food, which is things that don't really correct very easily. And that is still going up, but we feel that it's a matter of time until this turns as well in Europe. We've put this slide here to illustrate really the magnitude of the amount of liquidity that have been injected by the central bank in the US over the past 10, 12 years. So we had several series of quantitative easing, which created trillions of dollars. But what is interesting here is also at the time of COVID, how large the liquidity injection was just in a very short period of time to fight COVID. And unfortunately, this will have to be repaid at some point. And inflation is a bit of a consequence of this. So inflation always have, different triggers. It's hard to pinpoint something, but some of the triggers was coming out of COVID, the bottleneck, then the war in Ukraine, which put a lot of pressure on commodities and energy prices. But also in the background, we had this vast amount of liquidity in the economy that was there to, that needed to be withdrawn. So part of the work of the Fed has been to increase interest rate to try to reduce the size of the balance sheet.
But it's important to add, maybe, inflation wasn't caused by Ukraine, etc. Yeah. It was just a trigger. Was the first domino, let's say, that impacted this. I mean,
it was always going to be there, but like in financial market, there is always a trigger that just create an effect.
And so we've seen this significant rate cycle. And where are we now?
Because inflation has turned a corner, we feel that we're probably at the peak of the interest rate hike cycle. And in May, we've seen another small 25 basis point increase, which probably be potentially the last increase. I know the market is still divided on this, but there's definitely most of the tightening has happened now, and that gives us a base to work from. And we'll come back to it in a minute about why this is important. The Fed tightening has really restricted financial condition, and the money supply has come down dramatically. Financial conditions are very tight as well. Is that the black line here, which is inverted? So when it's going down, that means financial conditions are very tight. So the Fed has done its job of restricting the economy. So the labor market has been an interesting one. It's fair to say that the labor market has been very tight in the US. And this is quite an interesting graph that I use often, is the number of job opening, which is the green line at the top, is the number of job open per person unemployed. So per person looking for a job. And then we are at 1.6, 1.7 job open per person looking for a job, which is unprecedented really. So definitely the US market is very tight.
The fact that we've had this rate hike and still the employment market is quite sticky in the US.
It is definitely the wage hike and the wage pressure is starting to ease, but it has been a big headache for the Fed because it's a big driver of inflation.
Yeah.
But we start to see some potential crack here. And again, we'll come back to this in a minute when we sort of combine everything into our conclusion. But the labor market is at historical, or the unemployment is at a historical low. However, the job opening unable to be filled is a good indicator of whether things are going to turn or not. And that's the red line here on the graph. And it seems to at least precede the trough in unemployment. I'm not a specialist in technical, but we can see that things have started to potentially go through an inflection point. And that's very important for what we're going to talk now, which is where we are in the cycle.
Okay.
So all of it is good, but now from an investment point of view, we need to understand how to position our portfolios on the back of this. If we look at typical characteristics of each part of the cycle, we can see that we're ticking a lot of the boxes of the late cycle, potentially / recession part of the cycle. So if we go through a few, overall growth, GDP growth have been going down. So it's still growing. So we're not negative territory for most countries, but the growth has slowed. The labor market, very tight. That's also definitely a tick, but also peaking. So that's an interesting point. Credit condition, very tight. The Fed starting to taper, and so increase, but not increase as fast. And inventories rising as well. So we definitely ticking a lot of boxes of a late cycle part of where we are in the economy. We can see that some emerging markets are definitely not in the recession territory yet, but the UK, the Eurozone are potentially already in a recession, even though it might be a technical recession. But while the US is really on the brink of very slow growth, potentially entering recession. So is next up a recession. So based on what we just described, it ticks a lot of boxes of very late cycle period in investment cycle. So if we just compare versus history, a lot of the indicators also are pointing towards a recession now. And we're coming back to the unemployment rate, which is a very interesting one, because it's a bit counterintuitive. When the economy is at full employment and everyone has a job, it seems to go well. Wages are growing. It doesn't mean that the country is not very close to enter a recession. And this graph is interesting, is that at every point, at every low point of the unemployment rate was really the beginning of a recession. So it doesn't mean that because the economy is doing well now and people are very employed, that it doesn't mean that in 3, 6, 12 months time, people are going to lose their job at quite a rapid pace, unfortunately. Yeah, that guide then gives us indication or direction of the economy. And again, every time the leading indicators turn negative, it's preceded a recession by a few months, and we've turned negative, and we've been negative for a little while. The real GDP, which is the bottom part, it's still in a positive territory, which means that in the US, we're not in the US in recession yet, but it's very close. And a lot of clues are making us a bit concerned. This is a bit more technical, but that's another indicator that historically, when the yield curve inverts, it signals a recession. So only once in history where the US yield curved and across the different maturities, when they invert, that means that long maturity yield is lower than short maturity yield. It preceded a recession as well. So it's another clue that makes us believe that potentially a recession is around the corner.
And this one probably is the most interesting one, I think. And the Fed always breaking something. And what is this a trigger for? When the Fed one says this is a trigger, is it correct to say that this is a trigger for the Fed to slow down in rate hikes because it sees cracks in the economy?
Well, it's often a trigger that the Fed has gone too far, maybe too quickly, and something breaks at the end. Like potentially what we've seen with the banks is a consequence of the Fed increasing interest rate too quickly. Too aggressively. And it made an imbalance like a mismatch in the balance sheet of these banks. which created a shortfall potentially for the depositors in those banks, and then it's created a bank run. So is the banking crisis a trigger for the next recession or consequence? It's interesting to see that there is always something happening in the market or in the economy before we enter a recession. So current market valuation, and this is in US market, we're trying to put perspective on where we are in terms of valuation. So yes, last year was a very difficult year, but we came down from very overvalued. The market is still not cheap. That's pretty much the conclusion of this. We back to potentially the average 20 years, 25 years, maybe even slightly above the long-term average in terms of valuation in the US. So US stock is definitely not cheap. How can we just assess what the potential downside would be? We assigned probabilities, everyone can assign their own probabilities about a mild recession or no recession. Our view is probably mild recession. If we had to update this now, probably be more than 40% into a mild recession. Compared to the recent performance, is there more downside potentially in the market? Typically, in a mild recession, from peak to trough, the equity market in the US could lose about 30%, about 33% historically in a mild recession. And we've done about, call it 20 in the course of last year. So the difference and what could potentially still come if we enter a mild recession could be a 10 to 15% downside.
We're still speaking US markets there.
This is US market, yeah.
Actually, this is a great chart because it shows a difference, significant difference, I think.
Yeah, so the US market is not cheap and there's potential downside. But if we compare to some other part of the world, let's say the European market, we see a big discount on European equities currently. And if we look at emerging market valuation as well, we also see that here emerging markets have been getting cheaper and cheaper compared to the developed world. And in absolute term, in terms of PE ratios, values, it's we definitely not in an expensive market. We're at an interesting point in time. There is still a lot of risk out there, a lot of volatility. We expect the market to really be volatile for the rest of the year and probably going into next year until we see a clear direction and until we've got clarity on, where we are, where the interest rates are finally going to be. Are we seeing all of the tightening or not? Is there more to come? Has inflation turned for good, which it looks like it, but there's still a lot of uncertainty. And based on that, we position our portfolio that way. So a recession doesn't necessarily mean difficult market or negative market. There's plenty of pockets where we can find values in this type of the cycle.
What's actually really exciting is the fixed income market, because it's almost been dead for many years now compared to equities. And here you can see the significant jump in returns in fixed income instruments. And so we are definitely looking closer to fixed income now. And you're getting, compared to historical levels, significant returns on your fixed income. I mean, just the jump there in defensive fixed income compared to before.
No, absolutely. And we finally start to see real return in some markets, which was at interest rates close to zero negative. It was very difficult to have any real return in the fixed income world. So we're quite excited about some opportunities in the bond market. We feel that they're cheap and there's still good value in it across the line, probably in the higher quality side, which is more government bonds as well as investment grade. We're just going to get to that in a minute, but the higher quality, slightly longer duration part of the fixed income. If we look again at the yield pickup that we've seen over the course of last year, it's quite significant. We've got 3, 4, 5% yield pickup now, pretty much across all the different fixed income asset class, which makes our life much easier to pick investment alongside our equity holding. We are definitely into a late part of the cycle, potentially entering a recession. However, even if we enter a recession, it doesn't mean necessarily bad return. It means that we just need to be in the right asset classes that will bring some good returns. The way we've been positioning our portfolio is we focused on high quality stocks, with strong balance sheets, so they're not impacted by high interest rates. Predictable earnings is very important. Pricing power, so they can pass on the prices and protect the margin in inflation environment. And there's simply like stocks that can have a really good return on equity. And these historically have been doing quite well in recession environment. On the bond side, as we mentioned, there's definitely opportunities now, longer duration and higher quality as well, which would be more the government bonds and investment grade, where we see opportunities. We feel the dollar has started to correct already, which has been good for our gold position. The dollar is probably going to continue to correct. Potentially, we're seeing that happening against the euro and the pound recently, but that also will be good for emerging market. So this would open opportunities outside of the US as well. The usual adage to say stay invested and buy on weakness will be more important than ever. And then we see that a more traditional medium risk portfolio, more balanced portfolio are set to potentially provide significant return, because we can finally benefit from both asset class, which is fixed income, and equity going up in the next few months.